A client came to me last month with exactly $40,000 saved. And he said, is this even enough anymore, or should I wait to buy a home? And by the time we were done planning, he realized he could have bought years earlier if someone explained the math to him the right way. So today, if I had $40,000 saved in 2026, I'm gonna walk you through exactly how I'd use it to buy a home, step by step, with no fluff, no wishful thinking, and nothing hidden from you. This is the real blueprint. The loan type, the down payment strategy, the credit prep, closing costs, what I'd avoid, and the exact sequence that I'd follow. But before we hop in, if it's your first time here, make sure that you hit the subscribe button and also tap the bell so you get notified on all the new content that we're putting out every single week. Really appreciate that. All right, so let's understand what $40,000 can actually do in 2026. Here's the reality. $40,000 is not enough for a 20% down payment on most homes, and you don't need 20% like many people think, but it is enough for a primary home buying using FHA 3.5% down or a conventional 3 to 5% down with closing costs and reserves factored in. Depending on your price point, we might also be able to have some money set aside for a rate buy down as well. But the key truth here is that $40,000 is not the barrier to you buying a home. The strategy you're using is. So let's talk about the right loan based on the home that you want. If I had 40 grand, here's exactly how I'd choose. Option 1 is a conventional loan with 3 to 5% down. This is gonna be the lower long-term cost for you, faster PMI removal, and this works best when you have strong credit, at least 680 or greater, ideally 700 or greater. And this is really good for townhomes, condos, or starter homes. Option 2 is gonna be the FHA, Federal Housing Administration, 3.5% down. Now this is best for you if you've got credit in the mid to lower tier or a higher debt to income ratio. This type of loan is gonna give you more flexible underwriting and easier approvals in most cases. The downside is that the PMI, the mortgage insurance on FHA, is generally a little more expensive long-term, but it's often the fastest path to you getting into a home. So which would I choose with 40 grand? Conventional 3 to 5% is the best if your credit is strong, like 700 plus. But FHA would be better if you need more flexibility, you're stretching your affordability, or you have lower credit like 680 or less. Definitely want to look at FHA for that. So next up, let's talk about the $40,000 allocation plan. Here's my exact breakdown on how I would do it, what I would use, and what I would go about. Let's hop over to the whiteboard here. So for the down payment, we're going to be looking at $15,000 to $20,000. This is going to give you enough for the down payment on a $300,000 to $450,000 home. Next, we're going to talk about closing costs. You have to have the money set aside for closing costs. So this is going to be like $10,000 to $13,000 here towards closing costs. That should be enough. That includes the lender fees, title, escrow, insurance, that sort of thing. Next is going to be reserve. We definitely want to make sure that you've got some money set aside for after closing. So the reserve, we're going to say $3,000 to $5,000 for your emergency fund and your reserve. Because buying a home with no margin, with no reserve, that's exactly how you can lose your home and be in a really bad financial situation, okay? So you wanna make sure that you've got that reserves for sure. And next is gonna be the buy down. We're gonna use the extra money available for the rate buy down because as we discussed, a rate buy down can lower your monthly payment. That can be great. So here, depending on your price point, you're gonna be looking at $3,000 to $7,000. That'll go towards the buy down. Now, buy downs can sometimes be one of the best investments that you can make when buying a home because it can reduce your monthly payment permanently on the property. But what you wanna do is run a break-even analysis to see if it makes sense. You're gonna wanna do that with your lender. That's gonna divide the cost of the buy down by the savings to see how long it takes to recoup that investment. Generally, we wanna see a recoup time of 36 months or less on the buy down. Most buyers put all $40,000 into the down payment, and that's a big mistake because the strategy here, splitting this up, this wins every time so you don't get caught off guard. Now let's talk credit strategy. This is the part that a lot of buyers completely forget and undervalue. I'll explain exactly what you want to do 90 to 120 days before you buy a home. So the first thing is pay down revolving debt. You can definitely have debt when you apply, but we want to have that debt as low as possible, specifically on your credit cards to maximize your score, lower your debt to income. Next thing is don't close old accounts. You want to leave all your accounts open so that that history is reflecting on your credit score. Don't open any brand new accounts. That can be a red flag, and that can temporarily lower your credit score as well as increase your debt to income. So don't do that. And that includes don't buy a new car or any large purchase like that. That could have a detrimental impact on your affordability. And next is don't move any large amounts of money without being able to document it. There is a lot of cases where underwriters will ask for documentation if they see large deposits and things like that in your bank account. Make sure that all of your balances on credit cards are 30% or less of the credit limit. That's gonna really maximize your credit score. And the protocol that I use with my clients is something called the 50-30-10 rule. This is where you look at your credit card limits and you get the balances down to the different thresholds to maximize your score. So the first threshold is 50% of the limit. You wanna have your credit card at 50% of the limit or less. The next threshold is 30% of the limit. And the last threshold is 10% of the limit or less. So by having your credit card debt in those brackets, 50-30-10, you're gonna be able to maximize your credit score. When you get to that 10% or less utilization, you're gonna have the absolute maximum points on your credit score. And an extra 20 or 40 points on your score, that could save you hundreds of dollars a month on a conventional loan. And that's a lot more valuable than just saving up a little bit higher down payment. So the next thing you wanna do is pick the right property type for $40,000. What I'd be looking for here is townhomes or condos with undervalued HOAs. Single family homes just outside the city centers. Areas with upcoming development that's not really priced in yet. For example, a new Whole Foods, Trader Joe's, or Starbucks that's opening up. A lot of time that can foresee future home appreciation. Properties with cosmetic issues, that can be fixed. So you want to look for properties that may have a little cosmetic issue, but not structural ones. Those are the ones that are really expensive and difficult to fix. What I would avoid is new construction upgrades that inflate the cost of a home. I'd definitely be avoiding properties that have old roofs, old HVAC and mechanical systems. That can be huge red flag to have increased spending when you buy a home, is buying one with old mechanicals, old roofs. Stay away. Homes with insurance red flags, things like fire zones and flood zones, you really wanna stay away from those. And if you have to buy in those areas, make sure you know what you're getting into. Make sure you know the increased coverage you're gonna need for home or flood insurance. Homes with artificially low taxes that'll shock the escrow account. This I see with properties that had recent upgrades or new construction. A lot of the time you'll see that the tax rate is really low, but then in year 2 it jumps and creates a big budget issue. All right, so in our next section, we're gonna talk about the actual 2026 step-by-step buying plan. So let's break this down into 8 steps. First of all, find a mortgage advisor, pull a soft credit report, run your affordability. That's step 1. Step 2, run program comparisons. Do like FHA versus conventional side by side so you know what loan program is going to work best for you. Third, allocate the $40,000 that you have into the different buckets for the closing costs, the prepaid items, rate buy downs, reserves, all of that. You need to have it all allocated. Next, get a full pre-approval, not just an online pre-qual, but a full pre-approval where they look at all your documents. When you're looking at homes, don't just start with listings, but start with neighborhoods that you're interested in. That can be a big advantage. Look in high negotiation months. Times like late summer and winter can be great times to buy because there's less buyers in the market, less competition. Evaluate asking the seller for concessions. Talk to your realtor about maybe preserving some of your down payment money and putting that towards other things so that the seller can buy down your rate. Instead of you paying the buy down, have the seller pay the buy down. Don't go under contract without running the full payment scenario. This is a big one. Know your budget, know what you're getting into so there's no surprises. So the big mistakes that I see people make with $40,000, that's what we're gonna handle here on our next section. Using all the money for the down payment, that's the biggest no-no, is that people don't allocate the money correctly and they think they're gonna put all of it towards their down payment. That doesn't leave money for the other things that we talked about, closing costs, reserves, buy downs. You can't ignore closing costs. Those are part of the transaction. Another thing that I see a lot of people do is they buy more house than they need. This is not the market for that. You want to stay responsible and buy only what you need. Another big issue is not preparing your credit early and having last minute issues and last minute stress. Make sure you're looking at that credit report 60, 90, 120 days before you go forward with applying for the mortgage. Picking the wrong loan for your situation, that's a big problem. Conventional isn't always the best bet. Sometimes you can actually save money by looking at a VA loan or an FHA loan, depending on your circumstances. Huge mistake I see a lot of buyers make now is closing without any reserves. They have all their money allocated, but they forget to do reserves. And that's a big no-no because you're gonna find yourself in a situation where you don't have extra money available and you end up gonna have to go into debt or use credit cards. Something's gonna happen. It's not a matter of if, it's a matter of when. So you wanna make sure you have ideally 3 to 6 months of mortgage payments in reserve for these unforeseen issues. Not budgeting for insurance hikes. That's a big issue now because we're seeing insurance and taxes go up. So you wanna make sure, again, you've got money set aside in reserves to budget for those insurance hikes and taxes so you can take care of those with no stress and no issue. And a lot of buyers now, they're still assuming that they need 20% down. But look at all your loan options. 3 to 5% down is a great place to start. You don't buy with maximum down payment, you buy with maximum strategy. So if you're somewhere around the 40K mark and you're looking to buy this year, reach out and I'll help you run the numbers for real and build a custom plan tailored to your situation. Next, watch my video called DSCR Loans in 2026, What's Changing and What You Need to Know. It ties in directly to this if you're thinking about buying an investment property down the line.